Hi there, welcome to Kneppy Invest and welcome to another technical update video. It is the 1st of December, the first day of summer, also the first day of my least favorite month of the year. And I'm saying that as an investor, if I just set aside my investing cape, I actually don't mind December, particularly the last week. I don't mind the period between, say, Christmas Eve and just after New Year's Day because there's a lot of public holidays during that period. And I don't mind working those public holidays. I don't mind working Christmas Day or even New Year's Eve. In fact, I'd probably prefer to work than doing anything else. But that's just me. Maybe I'm a little bit weird. Okay, what's the agenda for today's technical update video? Go through the indices, commodities, Bitcoin, bonds, currency, that sort of thing. Now, the interesting thing about today's video is when I get to the individual companies portion of the video. So what I'm going to do is use this particular tweet as inspiration. This is from Lawrence McDonald. Talking about something Charlie Munger said. Now, I'm not absolutely certain that Charlie Munger would say this because it goes against what Munger and Buffett have said in the past about technical analysis. But anyway, we'll believe Lawrence McDonald. When Market Speaks, bestseller on Amazon, the epilogue, chapter number 1. I was sitting there in Omaha across the table for Charlie Munger, one of the all-time greats. I'll never forget this line. He said, "Larry, if all you ever did was buy high-quality stocks on the 200-week moving average, you would beat the S&P 500 by a large margin over time. The problem is few human beings have that kind of discipline." Now, the first thing here is understanding the difference between a low-quality company and a high-quality company. And I think that is the first thing, probably the most important thing when it comes to this particular strategy. Now, I would also say I'm not a big fan of ETF investing because I think we all can significantly beat the market. And by just ETF investing, we're just giving in. We're saying, no, I can't beat the market, and I'm just gonna be happy with normal returns. And this is a simple strategy that needs just a little bit more work than ETF investing. And I think this sort of strategy, you could significantly beat the market, and maybe Charlie Munger is absolutely right. So what I've decided to do is go through some of my high quality companies in my portfolio just to see if I can find any good times to buy these companies in the past, or even if right now is a time to buy or add to my positions because the share price is at the 200-week moving average, or even below the 200-week moving average. Okay, and maybe just having a look at the weekly chart and having a look at what the share price has done compared to the 200-week moving average, we can determine whether a company is or is not high quality. I have prepared about 23 companies. I might try to whittle that down, but I also want to include BHP. Yes, I want to include BHP just because that is a company I don't own. But I'm just wondering, because I was thinking, mining companies are not high quality, but if there is a high quality mining company, it might be BHP. So I just wanted to see if this sort of strategy would work for BHP. So I'm just going to include BHP in this list. A lot of companies here. Probably won't go through all 24, but we could just see if this strategy has worked or could work for these sort of companies. Okay, so let's go back to the indices. Let's start with the Australian indices, and pretty good week. And in fact, I'm going to go back to I'll go to the weekly chart. XJO, for some reason, it's not expanding. There it is. It's there we go. Is anyone out there complaining what's happening with the XGO, the Australian market, international markets, NASDAQ, New York Stock Exchange, that sort of? Is anyone complaining out there? I'd say no, because right now the XGO has had 4 pretty good weeks. Well, 3 pretty good weeks and 1 week where it did absolutely nothing. And we are at all-time highs, actually up 0.5% for the week. And probably the other thing you notice when you look at the chart here is the XGO is above the long-term, or the top of the long-term channel that has been trading in for about 15 years. Now, there's 2 ways this could go from here. It could continue going up, and that would mean that the channel has been broken and it's no longer in play. And eventually that will happen. The other way to look at this is it's overvalued. The market right now, the SEO is overvalued, and we might see a bit of a reversion to the mean. So maybe we could fall back to, say, the mid 7,000s, 7,500, or if it becomes a little bit nasty, maybe we could drop all the way down to, say, 6,900, which would be the bottom of the channel, which would be a fairly big fall, but not something that doesn't happen all that often. These sort of corrections happen a fair bit. In fact, all you have to do is have a look at the weekly chart for the SGO over the past 15 years. In fact, unfortunately, TradingView is not updating, or auto-fitting. There we go, auto-fit. And if you just have a look at the chart for the SGO over the past 15 years, you always see the SGO pull back. It happens time and time again. And it's going to happen again in the future. And the way we react to these corrections or these pullbacks is really important. I consider these times or those times to be opportunities. But anyway, the most important thing here is maybe the SGO is getting a little bit overbought, maybe a little bit overvalued. And I have no doubt the four big banks have something to do with this. And because I do think the four big banks are overvalued, I would not be surprised to see a significant pullback. But I just don't know when that's going to be. Now, the XSO, this does not include the four big banks. So I'm paying more attention to this one. And this index is looking really good at the moment. A pretty good week for the XSO, up 1.5%. Oh, 1.88%. So a little bit off there. So a really good week for small caps in Australia. And if you actually do have a look at the weekly chart here for the XSO, and if you go back a couple of months ago, so October, there were 2 weeks here where we did see a bit of selling when the XSO got above 3,200. And the reason I say they're selling is because there was two shadows above the main body. So it means whenever the XSO got above 3,200, there was a bit of selling in small caps. And right now, the small caps or the small ordinaries, XSO, is right on 3,200. This is starting to look a little bit bullish. And I wouldn't be surprised to see some more buying coming in the small caps and this particular index going up. So I like this weekly chart for the small cap index, the XSO, and even the daily chart. But I'd like to see it get above those highs we saw back in October. That would be a good move moving forward for this particular index. But I do like this particular area more than the XGO, more than the ASX 200, particularly the ASX, say, 20. I'm not a big fan of most of those sort of companies. Okay, so that's the Australian indices. For those who wonder why I never look at the XAO, the All Ordinaries, it's because it's almost identical to the XJO. A little bit different, subtly different, but it's almost identical. Okay, so now let's turn our attention to America, United States of America. I'm half American, for those who don't know, half Australian, half American. I've lived many years in the United States. I do prefer Australia, but there's many things I prefer. When it comes to some things, weather is one of them. Sporting culture, I actually prefer United States over Australia. And the main thing is because every single night there's a sporting contest happening. There are also mountains. I love mountains. So you might say, well, there's some mountains in Australia. No, there's not. If I had to live anywhere in the world, it would be Colorado. There are some places in Colorado I would love to live. Maybe Wyoming, Montana, in the mountains there. I just love mountains. I don't know why. It's just me. Anyway, so let's turn our attention to NASDAQ after a little bit of a detour. And we'll go back to the weekly chart. NASDAQ, flat. Relatively flat. Well, actually, it was up 0.74%. That must have been because of Monday's session. Still a little bit behind, or a little bit below the all-time highs, which were reached a few weeks ago. And if we have a look at the daily chart, you'll probably see it was a really good day on Monday. Where was it? Yeah, Monday. In fact, it opened up high Monday and then fell, and then the rest of the week was fairly flat. That's right. There was no, wait there. Oh, there was no trading on Thursday. That was Thanksgiving. For some reason, I was thinking there was no trading on Monday. That was Thanksgiving, but it happened on Thursday. Thanksgiving is always on a Thursday. Anyway, so are we complaining about the NASDAQ? No, but it's not as good as the Dow Jones Industrial. If we go back to the weekly chart, have a look at Dow Jones Industrial. Really good week for that particular index, up 1.4%. After last week being up 1.96% and another all-time high for the Dow Jones Industrial Average. In fact, this chart does look better than the NASDAQ. So things are moving really good or looking really good for American companies, particularly the bigger companies. What about the smaller companies? So let's have a look at the Russell 2000, which is the smallest 2,000 companies in the Russell 3000. So this is like a small cap proxy index. In fact, it is called, if you look in TradingView, US Small Cap 2000 Index, but it is called the Russell 2000. And just by looking at the weekly chart here, it's pretty good. I like this one as well. So quite a few months ago, I put in this purple box, which was a resistance zone for the Russell 2000. It broke above that about a month ago, and it has continued to go higher. But not only that, what I'm going to do now is put a line that I haven't put in before, and that was highs we saw, or the Russell 2000 saw back in July. November. No, wait there. This is the weekly chart. Yeah, this is November 2021. The Russell 2000 is at that level, so we're almost at all-time highs for the Russell 2000. So the whole reason why the Russell 2000 had a big dip is because of rising interest rates. It has now recovered back to those levels that it was before that drop. So it's looking really good. Possible. What's it called? The teacup handle, the teacup handle. I forget what it's called. Teacup handle, something like that. Technical cup handle. If you have a look at cup handle, for some reason there's cup handle. Have a look at some images. I thought for some reason there was a T in there. Yeah, it sort of looks like this, doesn't it? So the cup and the handle. Am I just seeing things? Has a potential, I suppose. We haven't seen the handle just yet. So this is the cup handle. Apparently, it's a fairly powerful structure. I've read that in a few books. And so we have the cup and the handle. And if we go back to the Russell 2000, we might have the cup. And if we do see a pullback here, that would be the handle. Anyway, I'm just throwing that out there right now. Just showing you that I know some stuff, a little bit of stuff. Anyway, but I couldn't name it. Teacup handle. For some reason, I thought it was teacup handle. Anyway, so Russell 2000 at an important level. Now, if we see it break out above 2,440, that teacup handle is gone bye-bye because it's broken out. Anyway, let's have a look at some international indices. We'll stay at the weekly chart. By the way, let's have a look at the daily chart for... this is a beautiful chart. I like this chart. Look what's happened to the Russell 2000 since it hit that resistance level, those hold highs, and that was on Monday's session. It got to that level, and it's been going sideways ever since. So there is a little bit of resistance there for small caps in the United States. So wouldn't be surprised to see it break out above that in the next few days, or wouldn't be surprised to see it pull back. Again, there's a lot of possibilities. It's all about probabilities. It could happen either way at this point. Okay, so let's turn attention to the Nikkei, or international indices, and we'll revert back to the weekly chart here. Nikkei down week. There you go. Down at 0.2%. So we'll call this flat. And in fact, the Nikkei has been going sideways for a while. A bit of volatility in there because of that the yen carry trade, which everyone has forgotten about. Don't hear that anymore, do we? But still, the Nikkei has been going sideways on the weekly chart, even the daily chart, just going sideways. If you take away that yen carry trade debacle, if we just ignore that ever happen, yeah, Nikkei is just going sideways. We could say this is a consolidation phase, and what I'll be waiting for is a breakout. Hang Seng, go back to the weekly. So we have seen a pretty big pullback from 23,000 down to 19,423. I don't think we want to see it fall much further from here, and I'd like to see the Hang Seng rally. If we do start to see a rally, that would be a good sign moving forward. But that rally on the back of stimulus in China, we saw back in September, early October, has petered out. So what happens, I suppose, in the next month or so is going to be very important. Are we going to become more bullish when it comes to China and Hong Kong, or is this it? Or are we just going to go down further from here? Again, not much confidence either way for the Hang Seng. What about German? The DAX always looks pretty good, but I'm always hearing about how bad it is in Germany right now, how the economy is tanking, everything is dire, that sort of thing. But when you look at the DAX, it's completely saying the complete opposite. Well, saying the complete opposite, because I said completely or complete twice there. So this could be further proof that the economy and the stock market are not the same thing. You can see the stock market tank and the economy do well, not that often. But in the German case, the economy is not doing well, but the DAX index is doing pretty good. still going up. That's the weekly chart. Almost got to all-time highs this week, just shy, it looks like. Just shy, right on it, 19,600, or just above that is the all-time highs, which were in October. So the charts for the DAX, the daily chart, weekly chart, look okay. And what about the UK? What about the FTSE, FTSE? Going sideways. Continue that theme, moving sideways. It looked a little bit weak about a month ago, but it has recovered, and now it looks like it's just going sideways again. So the FTSE going sideways. It's been going sideways for about 8 months, 7, 8 months. Okay, that's it for the indices. Now let's turn our attention to commodities. In fact, I haven't looked at these. I'm pretty sure gold had a bad day. Maybe that was on Monday. So let's have a look at the weekly charts. We'll stay with the weekly charts, and we'll start with gold. Okay, so a down week, and I have a feeling that was because of Monday. So down 2.4% for the week, after a really good week, after a bad week. So a little bit of volatility in gold. I think mainly because of Trump, or what's going to happen with commodities, with gold, with Trump in power. No one really knows at this point. That's why there's volatility. And if we do have a look at the daily chart, yeah, there was one big down day on Monday, and not much happened since then. Going, I wouldn't say sideways. It's been going slowly upwards, slowly upwards, down 3.36% on the Monday session. So the daily chart still looks okay. Weekly chart still looks okay for gold. No complaints about that. Now, what about silver? Because this one was looking much weaker. And there will always be correlation between gold and silver, but sometimes you do see a bit of a disparity between how gold moves and silver moves, which does lead to opportunities for those who think maybe silver is much more better value than gold. And I hear that quite often. Anyway, so the weekly chart for silver, I still would say it's in an uptrend. In fact, what I'm going to do now is put an uptrend line here. I think we do have an uptrend here. So we just put it like that. Looks like there is a bit of an uptrend, short-term uptrend since start of 2024. We have seen a bit of a pullback, but looks like maybe it's trying to move off that uptrend line. Probably be able to see this a little bit better if you look at the daily chart. Yeah, you can see that on the daily chart. It has trying to bounce off that uptrend line. I'd love to see a really good bounce from here. I'd love to see it bounce off here and get above the previous highs we saw back in October. So silver still doesn't look all that bad, a little bit of a pullback. And I think some of the silver companies on the ASX have pulled back significantly more than that. I know some people love Andean silver. So let's have a look at the chart for this one. Yeah, there was a pretty big pullback. There it is. Anyway, let's have a look at copper. I'm not as bullish, nowhere near as bullish on copper than I have on gold or even silver. Now, probably the one thing is $4 for copper is a pretty good support level. We saw copper hit $4 back in August, and it's getting very close now, and does look like it has been going sideways the last few weeks. So maybe it already has found support at these levels, so just above $4. So what we want to see is copper go on a nice little run. So that's the daily chart for copper. Weekly chart, yeah, it's maybe a longer term trend, but I'm more looking at the daily chart for copper here, and I really want to see it bounce from here. What about iron ore? Iron ore really hasn't had a trend. If anything, if you look at the daily chart, it's in a downtrend, if anything. So definitely not in the uptrend. Did get to as low as $90 back in September. Went on a nice little rally because, again, China stimulus. We all thought, maybe not all, but many investors thought that iron ore companies would be benefiting from increased stimulus in China, which is understandable. It's a good thematic. But we haven't seen much action since then. It's been going sideways, if not going slightly down. And if we have a look at the weekly chart, I see no trend. Absolutely no trend. I reckon this is more of a range trading sort of strategy, if you want to include that. It's just by looking at this, there's around $80 is a really good support level. So if it got to about $80, I probably would be more keen on buying some iron ore companies on the assumption that the share price or the price of iron ore would bounce. That could be a bad assumption, but the reason I would do that at $80 is because if it does fall through 80, that would be just a quick get out of that trade scenario. So what I'm trying to aim to do in the future is low risk, high reward sort of plays, and that would be that sort of play. So support level 80, get in around 80, and if it falls through that support level, get out fairly quickly. Anyway, so nothing much happening with iron ore. It's just meandering around, I suppose. Uranium has surprised me recently. I thought it was breaking out. It's dipped back. Again, this one looks like it's just going sideways. And we're just seeing some peaks and troughs, so maybe range trading again. So not as excited about uranium right now. This is the spot physical uranium, and just not excited with uranium right now. What about oil? Below 70. Now, oil, if you have a look at the weekly chart, doing nothing for like 50 years. Maybe not 50 years, maybe 20 years. In fact, the last time oil was in an uptrend was back in the mid-2000s. And it hasn't really done anything. Well, we have seen short-term uptrends, but yeah, it hasn't really got any higher since 2006. In fact, 2006, oil was $75, now it's 68. So definitely not the long-term or long-term play here. So I'd be more likely or inclined to just trade this in the shorter term. And at this point, nothing. I'm seeing nothing here for oil going sideways. If you have a look at the daily chart for oil, yeah, it's just been going sideways for 3 months. Anyway, so no interest in oil. I'm going to move on go past gas, lithium. What about lithium? Let's have a look. This is the lithium. What I'm going to do is have a look at the line chart. There could be a sign, maybe. The last few days of last week, lithium did rise. But we have seen that in the past. So I'm not calling the bottom just yet with lithium, but if it's not the bottom right now, I think it's close. But I just remembered that Lake Resources presentation when they said there's going to be an oversupply of lithium for the next 5+ years. I was like, why would a lithium company be saying that unless they're benefiting from that? It's a weird one to say, weird thing to say, but that is always in the back of my mind, that there's an oversupply of lithium for the next 5 years. 5+ years, I think they said. Okay, let's have a look at, coal. We'll have a look at coal just to see if anything's happening. And the answer to that is no. Tin has turned negative. In fact, I think I've just ignored tin the last few weeks, but tin has turned negative, has broken through or below those lows we saw back in August. So that means Medicus. I think Medicus is one of the tin ASX company, and this has been going sideways. Share price of this company hasn't fallen below the lows in August, so still above those lows. So not much of a trade there for Medicus or tin. What about nickel? And this is another one where we need to look at the line chart. And nickel doing nothing. It is at support or just above support, but really nothing much happening with nickel. One company I do follow slightly when it comes to nickel is Centaurus. I think the reason why I do follow this company a little bit more closely is because I once was a shareholder of this company many years ago when they weren't into nickel. I think they were in iron ore at that point. And when you look at this, I think downtrend has come to an end, but it's not, it doesn't float my boat. And finally, Palladium. Okay. So I think downtrend definitely has come to an end here. We saw a really rapid decrease in price of Palladium about a month ago, and we've seen a rebound and a pullback again. I'd say this is more likely to see more volatility moving forward, or maybe just go sideways for a while before it might move into an uptrend. And if you have a look at the weekly chart for Palladium, yeah, so the downtrend was in play for a while, and I think we are at the bottom and maybe just a consolidation period. Okay, so let's have a look at crypto. Bitcoin is still not above 100,000. I did actually have a chat with someone I knew about Bitcoin, and I just mentioned I think it will take a bit of time for Bitcoin to get above 100,000, and because it's such an important level. And this person actually said, because they actually trade Bitcoin, that they sell they're not the stop losses, their sell price for Bitcoin, so they're trading it right under 100,000 because Yeah, because so a lot of traders would probably be doing that. So what's going to happen if Bitcoin gets above $100,000? That trade is no longer there. In fact, they're more likely to buy back in because it's got to an all-time high. There's no resistance, and maybe the next round number they're looking for is 150,000, maybe 120,000. So $100,000 is a really important level for Bitcoin, and if it does break above that, I think it could go higher or significantly higher. But we did see it hit. What was the high? On the 22nd of November, Bitcoin hit 99,800, and we have seen it struggle to get above that level. But, and don't forget, it's been on a pretty good run over the past couple of months. What about Ethereum? This doesn't have any problems in regards to a round number being a resistance level. And you can see Ethereum keeps on going higher. So it doesn't have that problem that Bitcoin is having right now. And I do like this particular chart. So if I was trading either of these two, I'd probably pick Ethereum right now over Bitcoin. But if Bitcoin breaks above 100,000, I'd probably prefer that one if I was trading. But I'm not. Bonds. I do know bonds had a bit of a fall. Yeah, bonds have pulled back a fair bit over the last, what's that, 5 days? Yeah, during the week, bonds has fallen. If you look at the weekly chart for the US 30-year bonds, it has dropped 4.84%. I don't know why. I haven't really delved deeply into why, but there is something leading to this. A few reasons. Maybe it's the bond market is now thinking, well, there's no way Trump is going to put in all these tariffs in place. There's no way he's going to do that. He's just, he's just bluffing. And I think if he is bluffing, and I think there is a chance he's bluffing, we won't see return inflation. So therefore, there's no reason for bond yields to rise. I think that maybe that's what they're thinking. I have no idea. Maybe there's different reasons. That means the TLT might have, TLT, the complete opposite. I wouldn't buy this though. Yeah, it's just a little bit of a bounce over the last few days. And finally, the currency. So maybe Australian dollar has rallied? No, it hasn't. Down at 65 cents. I want it to get above 70 cents. That'd be pretty good. I'd love it to get to $1 within the next, say, 6 months. And then it can do anything after that. It can pull back to 5 cents if it wants to. Oh, that'd be good. It pulls back to 5 cents when I'm overseas. Anyway, so nothing much happening with the Australian dollar. It has dropped a fair bit since September from 69 cents to 65 cents. Doesn't sound like a big drop, but that's a big drop for currency. Okay, now let's turn our attention to individual companies' charts. So I do have 24 planned. So I don't think I'm going to go through all these. And we have to look at the weekly chart. What I've done is we'll start with Aristocrat. So what I've done is I've just color-coded the 200-week moving average in black and shaded a little bit more. What I might even do now is increase the, not font size, the thickness. There it is, the thickness, there it is. Anyway, so most of these companies I do own except for BHP, which I've just included. So what I'm looking for here is we have the 200-week moving average, and how often or does the share price ever get to the 200-week moving average or even fall below it? So if we go back to Aristocrat Leisure, and the only reason this is first is because it's first on alphabetically. So the share price of Aristocrat has been an uptrend since 2014. If you go back even further than that, share price moved into a really nice weekly uptrend in April 2013 at a share price of $4. If you go back further, so this is probably not the, if you look at this chart, that's probably not the chart of a high quality company. And I could understand why someone might say that, but I know nothing about Aristocrat before about 2015. Started following this company back then, and if you have a look at the chart since then, the share price has remained, it did remain significantly above the 200-week moving average until the COVID-19 financial panic, and then it dropped below that and rallied quickly. So I'm wondering if we could just ignore that, because the only time, if you do ignore that, the only time over the past 10 years, the share price of this company has fallen below the 200-week moving average was back in, for a brief periods of time, back in 2022, 2023. In fact, I bought some shares in this company during that period. Not when the share price was below, so I just bought it just above, but I did find, or I did see value in Aristocrat back then. And since then, the share price has gone a run. So yeah, so this sort of strategy, buying this company, if you thought Aristocrat was high quality. Yeah, I could see that working. We've had a couple of times in the past 10 years where that was a perfect time to buy some shares in this company. We'll have a look at AUB Group. So probably the big question here is AUB Group a high quality company? This is, I could probably go either way. Now, if you look at the weekly chart here, share price has been in a beautiful uptrend since 2010. Didn't realize this company was listed that long. And 3 times in the past 10 years, the share price has fallen below the 200-week moving average for a long period of time back in 2015. So that would have been a good time to buy. Another good time to buy was 2019. It fell below it briefly. And then also during the COVID-19 financial panic. And then for like a week back in June 2022, it fell briefly below the line there. That would have been a great time to buy this company. And since then, the share price has almost doubled. So that strategy would work for this company if you thought AUB Group was high quality. I'm going to skip by Breville Group. I already talked about CSL in yesterday's video, so I'll briefly discuss it because I would say most people would consider CSL to be a high quality company. And this one was interesting because it remained above the 200-week moving average from 2012 all the way through to just recently, 2023. So 11-year period where the share price did not even get close. Maybe back in 2016 it got almost close. But it did not get close until 2022, and then it fell below the 200-week moving average for a period of time in 2023, and then rallying. In 2024, we have seen the share price of CSL get right on the 200-week moving average and then rally. So that's interesting. But I do think we are in a consolidation phase for CSL, and eventually the share price will break out. And that's the time to get on board the CSL Express because this company is still growing at a really good rate. So the company is going through a margin contraction phase. And when we see a share price break out, the company will keep on growing and maybe we'll see a more margin expansion phase for CSL. And the longer this consolidation goes, the better the breakout is going to be. Corporate travel. Okay, so I probably would consider corporate travel to be a high quality company, but I've really been asking myself, is it? And when you look at the share price of this company and the 200-week moving average, there's nothing here. Now, the reason I would probably call corporate travel high quality company is maybe because of bias. So I started following this company back in 2013-14, and the share price just went on a massive run. I was a shareholder for a long period of time during then, and then I was in and out of this company over the past 5 years. But since then, I don't know if you can call, just by looking at this chart, high quality. And not only that, looking at the performance of the company, not sure you can call corporate travel management high quality. Anyway, so if we did follow this buy high quality companies, the share price drops to the 200-week moving average, you would have been buying this company probably back in 2018, definitely in 2019. We saw it drop below that line, and then COVID-19 happened. And then it's been above and below the 200-week moving average quite often since then. So in this case, that strategy probably would not have worked. Okay, what about Fiducian? Now we'll move on from Fiducian because I'm not sure if I'd call it high quality just yet, but I think it has the potential to be a high quality company within the next 5 to 10 years. And if it is or can be portrayed as a high quality company, then I think the valuation of that company, actually, no, we'll have a look at the chart. So this is a position I've held for a long time. And I was just looking for companies that I think have the potential to be really big in the future. And this was one of those companies, Fiducian. So I forget when I bought, it was a long time ago. And funny enough, I do have this uptrend line in place. So that uptrend line right now is about 570. And we have seen, and the other thing I should mention is 200-week moving average, a company has to be trading for 5 years before we see a line. So Fiducian started trading in 2015, and we first see the line back in 2019. So it needs to be trading for a while before we get that 200-week moving average. And if you have a look at this period, twice the share price has fallen below that 200-week moving average. First time was the COVID financial panic. So we ignore that one. And then back in 2023. And I think during that period, there was really good value in this company. As a shareholder, I never thought about buying some more shares. And maybe I should have, because I thought eventually the share price will rebound. I just didn't know when. And it has. It has rebounded really well since then. In fact, share price has recently got to all-time highs. Anyway, so this was a case where I should have acted, buy some more shares, and I didn't. What about Goodman Group? This is a pretty good case. Another way you could look at this sort of strategy is how far away is the share price from the 200-week moving average. There is a bit of a risk there. Share price could fall back a fair bit. So for Goodman Group, share price right now is $38, and the 200-week moving average is about $24. So there's a chance the share price could fall back, not the $24, because it won't take. It will take a little bit of time for the share price to drop. So more than likely, the moving average would rise to say $26. So there is potential for the share price to drop. And the reason I say that is if you have a look at the long-term chart for Goodman Group, only twice has the share price fallen below the 200-week moving average. The first time was during the COVID-19 financial panic, very briefly, and then again very briefly in October 2022. That was prime buying time. And I bought just after that, but I didn't buy because I thought there was good value in this company. I bought because of the data center thematic. And I think a lot of the market had a similar thought as I did. Share price is almost doubled since then. What about Lovisa? I would definitely categorize this company as high quality. So we can see how this has traded compared to that 200-week moving average. Again, this company listed back in 2014. So we have so it must be 4 years. So 200-week, 4 years. 4 years, not 5 years. Why am I saying 5 years? 4 years, because 200 divided by 52 is 4. Ignore I said that. Ignore. Wish I could hypnotize everyone. Anyway, so 4 years. So this company listed in 2014, and the first time we see the moving average is 2018. And we have set, this is really interesting. So during the COVID-19, it did fall below it quite a bit. But since then, look at this. Beautiful bouncing off the 200-week moving average twice. The first time was in June 2022, and the second time was in October 2023. And just recently, the share price got close, but not quite. So this is another case where if you will find this strategy and you thought Lovisa as a high-quality company, you would have bought twice in the past 4 years, and you would have done really well. Okay, Medicus. Medicus. I would say some people consider this to be the highest quality company on the ASX. Some would say this is the most expensive company in ASX history. I haven't heard anyone say that, but I wouldn't be surprised people would say that. If you do have a look at the weekly chart, you see an exponential rise. So we're getting to the point, because the share price of Medicus has risen so rapidly, you need to look at a log chart. This is maybe a perfect instance where you need to look at log charts instead of linear charts because of this sort of rise. Now, the most important thing here is just, in fact, we'll ignore what's been happening recently and just go back to when the share price of this company broke out. And it broke out October 2013. That was, in fact, look at the volume. So I've mentioned volume. Look at the volume. So we started to see volume increasing in May 2013, and the share price broke out in October. Not much volume before that. Between 2009, when they made the acquisition of Visage Imaging, to 2013, nothing much happened with this company. And for some reason, the share price broke out. I would say more than likely that was in the back of some really good financial news. That was the time to buy. And since then, have a look where the share price corresponds to the 200-week moving average. Maybe only once. Share price got very close to that 200-week moving average during the COVID-19 financial panic. And the share price got very close to the 200-week moving average in June 2022. Remember, there was a lot of weakness in the markets in June of 2022. And that's why share price of Medicus fell to those levels, about $40. That was prime buying conditions for Medicus. Because look what's happened since then. Could have bought $40, now it's $251. So actually, this strategy would have worked really good for Medicus. 2 opportunities in the past 5 years. What about, no, I'm going to skip PWR Holdings. What about REA Group? And the reason I'm skipping PWR because I think I'm close to calling it a high quality company, but I'm not there just yet. REA Group, I'm a little bit different with this company. I probably would have said this company was high quality 14 years ago, maybe 12 years ago. Okay, so let's go back to 2012. all the way back to 2012. And there was a nice, during the GFC, there was a nice buying opportunity there in 2009. Could have bought some shares in this company at $3, or between $3 and $4. And since then, even the dips, they don't dip as far back until the COVID-19. Share price did drop below the 200-week moving average for a brief period of time. And then during 2022, during that overall weakness in the market, particularly tech companies, share price of REA Group dropped all the way down to $100. That was prime buying for this company because look at that, share price has taken off. So again, this sort of strategy would work for REA Group. A couple of really good buying opportunities for this company. You could have bought, say, even if you just bought when it broke down below the 200-week moving average, you would have bought, say, below $120 and you've doubled your money in 2 years, 2.5 years. Technology One. Yes, I would also categorize this as one of the highest quality companies on the ASX. I think there's no doubt or argument about that. Again, just like Medicus, share price has really taken off. It's gone exponential since that breakout when they released the results in May. I think it was the results. Let's go back in time because, again, I've been on and off shareholder of this company. And the question is why? Why did I ever sell shares in this company? So if you go back to 2010, I can't remember when I first took a position in this company. It would have been during 2013, 14. And then for some reason I sold. There was one brief period in 2018 when the share price fell below the 200-week moving average. It was for about 8 weeks, 2 months, and then it took off. So we have one instance there. And that's it, one instance in the past 12 years. On occasion, share price does dip very close to 200-week moving average. We saw that during the COVID-19. But really, this is a well-ordered chart. This is the chart of a high-quality company. So you could argue that very rarely do high-quality companies get to the 200-week moving average. But it does happen on occasion. And I think maybe being aware of this sort of strategy, and if we do think with high conviction that a company is high quality, then we can take advantage of these little dips. Maybe not little is the right word. Wisetech. Why not? Let's have a look at Wisetech. So again, this company listed in 2016, was it? Or 2015? 2016, so we don't have a 200-week moving average until 2020. And in fact, the 200-week moving average came into play just around the COVID-19 financial panic. And this is another case where the share price has dipped, but it's dipped just to above the 200-week moving average. The first time was during June 2022, and the second time was during October 2023. Even the previous dips we've seen in the last few weeks because of the shenanigans with, what's his name, even those dips have been nowhere near the 200-week moving average. So this is, again, a telltale sign of a high-quality company. And finally, Supply Network. I actually did include this one because I had a look at it and I went, there's been nothing. Supply Network, even when it dips, it doesn't dip all that much. This is an absolutely beautiful. Well, I suppose during the COVID-19 financial panic, it did dip right onto the 200-week moving average. And I suppose back in 2016, it did dip. But if you go all the way back to when the share price broke out of this long consolidation phase, and that was in 2011, share price has increased from 40 cents to $31.50. There's been two buying opportunities. 2016 and during the COVID-19 financial panic, and since then, nothing. And this is the reason why I did not take any or buy any shares until recently with Supply Network, because there was no significant pullback. I was waiting for that pullback and it didn't happen. And that could be a problem with this strategy. Some of these high quality companies may never pull back, or they might not pull back far enough. Okay, that's the Australian companies. Now I'm going to turn our attention, or my attention, to United States companies. Some of the highest quality companies in the world. In fact, I'd say some of the highest quality companies that have ever existed. Maybe not Amazon, but let's see if we can use this strategy for American companies. Some of the highest quality companies in the world. Don't know why there was an arrow there. So this goes all the way back, and we have seen opportunities with Amazon talking about 2006 during the GFC. But from the GFC until, where was it? Until 2023. So 15 years, there was no opportunity using this method to buy Amazon. Maybe close, maybe this was close back in 2015. That would have been close. So unless you're sticking strictly to the 200-week moving average, and maybe here you would say, well, it's close enough. I suppose maybe you could have that strategy. But recently it did fall below the 200-week moving average, and funny enough, I bought some shares during that period. I did not intend to do. That's not the reason I bought some shares. I just thought Amazon was pretty good value. In fact, I bought a lot of American companies during that period because I saw some value in those companies. So I suppose in a way, this was me using this strategy unintentionally. What about Google, Alphabet? Did the same thing happen? Yes, the same thing happened. And funny enough, in that tweet, I should actually mention this. In that tweet, he did use Google or Alphabet here. Yeah, there's between 2006 and 2024. There's been a couple of instances, yeah. Anyway, so let's turn attention to Alphabet. So I sort of knew this. GFC, yep. And funny enough, you can see the share price of Alphabet hit the 200-week moving average quite often between 2010 and 2011. I think it hit about 4 times during that period. And then since then, nothing much. Hit it perfectly during the COVID-19 financial panic and bounced off it. And then it fell through that moving average back in 2022. And I bought the week it fell through. That was not planned. Again, that was not planned, unintentional, but I just saw some value. Again, I saw some value. It's just the way it happened. Apple. Same thing happens with Apple. Let's have a look. I did not buy when the share price fell below the 200-week moving average at all. In fact, this strategy would work perfectly for Apple. And this actually goes all the way back to 2004. When did the iPhone come out? Wasn't it 2008? 9? I forget. I think the reason people started liking Apple would have been the iMac. I can't remember. And then the iPhone came out, and that's when share price of Apple really took off. Okay. So since the GFC, we've seen a few opportunities with Apple. So back in 2013, beautiful, bounced twice off it. And during 2016, and a lot of people bought Apple in 2016. Berkshire Hathaway bought a lot of Apple in 2016. Apple was considered a hardware company. So the P/E ratio of Apple was 12, if I remember correctly. It was really low. And a lot of people took advantage of that. And if you just use that strategy, if you consider Apple a high quality company, yeah, it was a good time to buy. Remember late 2018, there was a slight sell-off in the markets, and we saw Apple hit the 200-week moving average then and bounce off it perfectly almost. But since then, there's been no opportunities. Very close back in January 2023, and I bought just after that. But yeah, look at this beautiful looking chart. And in fact, Apple has reached new all-time highs. What about Microsoft? So we are looking at the cream of the cream, the highest quality companies in the world. You notice I'm not looking at Nvidia because that chart looks ridiculous. And I say ridiculous in the nicest of terms, but it doesn't work for these purposes right now. Microsoft, I think Nvidia needs a little more time to percolate. Now let's have a look at Nvidia. Why not? NVDA. And you can see why I mean, because when you look at the weekly chart, it's just gone silly since 2022. I suppose it did fall. It did fall below the 200-week moving average in October 2022. Silly me. It does work even for Nvidia. I thought it wouldn't work here. Fell to that 200-week moving average in 2018 and 19 for a brief period. Oh, I thought this wouldn't work, and it is. Oh, my voice thing on my iPhone just went off. It's called, what's it called? Siri or something. Anyway, since then, yeah, there's no. So I mentioned you could also use this strategy for downside risk. For instance, Nvidia could drop to its 200-week moving average. Now, it will rise from here, and that drop would be about 50%. So there is that potential. It could drop 50%, but that would be an ideal buying opportunity for Nvidia. Back to Microsoft. Microsoft, I've already seen one really good buying opportunity for Microsoft. Don't forget, for a 15-year period, Microsoft share price went sideways. from 2010 through to 2013, actually a 13-year period, share price of this company went sideways. Microsoft during its period grew. It grew and grew and grew. But the company went through a period of multiple contraction. P/E ratio kept on dropping. People were less and less willing to pay a premium for Microsoft. But the company kept on growing. So I mentioned that with CSL. CSL share price is going sideways. So this is what can happen when the share price goes sideways for a long period of time. Eventually, the share price will move back into an uptrend and break out. And that's what happened with Microsoft back in 2013. And to be honest with you, only once since then has the share price reached the 200-week moving average. And amazingly, it bounced off it to perfection twice. Now, the reason why this might happen is because maybe a lot of institutions use this strategy. Maybe, I don't know. Maybe it just works. Don't know why I've got these two lines here. Oh, I know I do. The first line, the bottom line is the bottom line is the low in the COVID-19, and the top dash line is the pre-COVID-19 highs. And I was using that when the share price of these companies was dropping. And I said, if the share price falls into that zone, I'll buy some shares. Now, Microsoft did not fall into that zone, but I bought some shares. I think I did the same thing with Nvidia, if I remember correctly. Because I remember just having these two dashed lines. No, that's different. Not sure why there's dashed lines, but I can almost guarantee you the reason I have these dashed lines for Microsoft is because of those two reasons. Anyway, so I bought some Microsoft shares just after the share price did reach the 200-week moving average. It broke out above the downtrend. That's why I bought some shares. And yeah, the share price has gone up. Taiwan Semiconductor Manufacturing Company. I know exactly why I bought shares in this company, because the P/E ratio looked really low. I thought, why is the P/E ratio of this company really low? It's ridiculously low. I'm going to buy some shares. And that was a good decision because the share price has more than doubled. Actually, it's exactly doubled since then. There we go. Anyway, so I think this is a high quality company. And if we do go back through time, this one does work as well. Yeah, so if we go back to 2009, we've seen the share price hit the 200-week moving average and bounce off it quite a few times. 2011, 2012, 2015. It hasn't really bounced off it perfectly well since then, but it's got close. And then it fell through the 200-week moving average during that tech sell-off. And I think the market was overreacting when it comes to this company. And then I had a look at TSMC back in early 2023, yeah. And I just thought, whoa, gee, that's good value in this company. And I bought some shares. This was a value play. This was not a technical play. This was just valuation grounds or on valuation grounds. And the share price has doubled. And now I think probably the company is overvalued, if anything. Okay. There is a company that I don't own, Berkshire Hathaway. I do know a lot of people like this company. I just wanted to see what a long-term chart. Does this strategy work for a company like Berkshire Hathaway? And we're going all the way back to 1980s. So we saw a dip, 1987, would have worked. The dip in 1990 would have worked. And then the dip during the tech sell-off, the tech wreck, would have worked. There was also a bit of a dip in 2003, a couple of dips during that period, 2002 and 2003. Bounced off it perfectly well in 2005. During the GFC, it went well below it. So that was prime buying conditions for this type of company. Also fell through it in 2011. Not sure what's happened there. And we saw it get close in 2016. Fell through it during the COVID-19 financial panic. And got very close back in 2022. Funny enough, this was one of the companies I was looking at to buy some shares in 2022, late 2022. And I was very close to buying shares in Berkshire Hathaway when the share price would have been around 425,000. Not this particular, would have been BRK.A. And maybe I should have, because it looks like the share price has gone significantly well since then. A few other companies I do own, but these are smaller positions. Oracle. This strategy has worked really well for this company for many times. Many times, in fact. It just continually bounces off the 200-week moving average. Gee, how many times? It has fallen through it on occasion, but many other times it's bounced. I'm seeing 1, 2, 3, 4, 5, 6, 7 times it has bounced off that. And for some reason, share price of Oracle has just completely exploded. Pepsi, okay, I've got Pepsi and Coca-Cola. I think there's one reason I've included both of these companies. I do own Pepsi, by the way, but not Coca-Cola. But Pepsi is, I think, and Coca-Cola, probably two companies that, not the sort of companies I would like to own, but I think both companies, because of what they do sell. So Pepsi doesn't sell Pepsi, they sell a range of different products. And I thought, well, okay, this is the sort of company that, yeah, I would like to own for the long term. So I suppose I am calling this company a high quality company. So, and the reason I've included Pepsi in this particular video is because look where the share price is right now. It has fallen below the 200-week moving average. So I'm thinking, ooh, I should add to my position in Pepsi right now. Yes, right now, because on occasion it falls below and significantly below during the GFC, but very rarely does it fall below for a long period of time. So maybe now is prime Pepsi buying time. Can the same thing said be true? Can the same thing be? Can it be true for Coca-Cola as well? I totally tongue twisted my tie to. I'm going to give up right now. Can the same thing be said for Coca-Cola? Let's have a look. And yes, I think the same thing can be said. If you have a look at the weekly chart, well, maybe not in the early 2000s, but definitely, I wonder, if you look at the chart for this company up until 2000, did this company get bought on the back of the tech? That's what it looks like. So these tech companies are really going well. Let's look for another tech company. What about Coca-Cola? That's a tech company, is it? That's what it looks like to me. So I didn't realize that other companies benefited from the tech boom, or the, what do you call it, the internet boom. It looks like Coca-Cola did. Anyway, if we look at, since 2009, yeah, I think this strategy would work fairly well for Coke. It does hit the 200-week moving average quite often. And right now it's just above. And finally, BHP. I said, and I was thinking in the shower this morning, I wonder if this strategy could work for BHP. I wonder, because if I had to say, because I'm going to say all mining companies are low quality, but if I had to choose one mining company that could be high quality, it'd probably be BHP. So we're going to see if this strategy could work for BHP. And I automatically go no. And the whole reason I say no is because of what happened with iron ore back in 2015-16. Iron ore collapsed. The price of iron ore collapsed, and you could just see BHP share price just collapse. And that is a telltale signs of a low quality company. But other than that, yeah, the share price does seem to respect the 200-week moving average. And right now, the share price is below the 200-week moving average. But if iron ore prices fall substantially, you might see the BHP share price fall substantially like it did in 2015. Okay, that's all I have for this video, and I'm so happy it has gone for about an hour, just below 1 hour. Okay, so if you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.